Welcome to Industry Focus. I'm Nick Sciple. Today we're continuing our Top Stocks Week on the podcast with Jason Hall joining me to share some of his favorite energy and industrial stocks for 2021. Jason, welcome back on the podcast.
It's good to be on. Belated happy birthday and happy new year, my good friend.
Thank you. It's great to be in 2021. It's I'd be remiss if we didn't mention obviously the news yesterday with the Capitol building being stormed by rioters, shutting down Congress's certifying of the election results of the 2020 presidential election. Not exactly what I asked for on my birthday. We watched the Capitol building. We have a view of the Capitol building outside of our window here in Alexandria. And I turned to my fiance yesterday. I was like, hey, if this building lights on fire, we're going to see this, right? And I don't think when I ever moved into my apartment, I ever thought I would be saying that, much less right. on my birthday. But we're here. We're not a political show, but we don't have any special insights on politics that's beyond what any informed citizen has, but we are citizens of America and citizens of the world watching this. Jason, what was your reaction from an investment point of view and just from a citizen's point of view seeing the events yesterday?
Well, we're humans too, right? These sorts of things, this isn't the sort of thing Americans of this generation have had to ever deal with. You have to go back to Vietnam the last time there were, anything like this happening in the presence, in the halls, of Capitol Hill, and certainly nothing like what we saw yesterday. I was flabbergasted. I was absolutely flabbergasted. And at the risk, I don't want to say anything partisan here. That's not what anybody's here to hear from me. But I think it's pretty easy to say that it was disgraceful and shameful. But to your point. What happened this morning?
Sun came up.
And democracy worked, right? Right, democracy worked. I think my favorite quote is, democracy is the worst form of government except for all of the others, right? Government is ugly, it's hard, and it doesn't always work, and nobody ever gets exactly what they want. And sometimes the people that don't get what they want lash out in ways that we don't expect. And here we go. We move forward, right? We move forward. Maybe the biggest takeaway: don't mix your investing with your partisanship, whatever it is.
And that's true. I was flabbergasted seeing the market, kind of powering through this with no results. But again, it just goes to show it's impossible to predict the market. I think, the important thing for me is what precedents do we set? And I think the precedent that we should set, and I hope we set, is that our institutions will hold strong in the face of these sorts of events, and that's important for the world. It's important for markets, and it's important for us as American citizens, me and you, Jason, and for I'm hopeful this is the worst is behind us and things look better going forward. But either way, the sun will come up tomorrow, and we'll try to be optimistic about what we can control and we can change and what we can improve going forward. With that being said, we're here to talk about top stocks. What do you look for in a top stock, Jason? Is that a good transition? How did I do with that?
I think you did about as well as any of us can, right? Here's the bottom line. I'll say this one little thing. I think one of the great things about America is that capitalism, this is the home of capitalism, and this has been the biggest test bed to prove that great companies can thrive. And you know what? Sometimes it's that strife and disruption where they come from. You think about David Gardner, you think about rule breakers looking for companies that disrupt industries, look for big trends, big things that are changing. And that's informed a lot about the way that I invest and the things that I look for, right? So the big thing that I start with is, what is the trend driving a company's prospects? And usually I kind of start the other way. I think about trends a lot. I think about things like the global middle class, right? This is just an interesting statistic that came across from me from following Starbucks and looking at Starbucks' growth in China and the expansion of China's middle class. China's middle class is going to be, in a couple of years, like 500 million people. So China's middle class is going to be bigger than the entire United States. And then I'm like, well, Africa's growing a lot. Latin America's growing. And there's all of these other places that are growing. And then you start finding out that the bigger trend for the middle class around the world is it's going to grow by 1 billion people over the next 10 years. And then the 10 years after that, it's probably going to grow by 1.5 billion people, right? So as much as the middle class trend hasn't been great here, around the world, that's a big trend. And then you have a big trend here where you have the aging of the baby boomers. So there's this big need for all of the things to support, them as they age in terms of healthcare and housing and that kind of thing. So you find these trends. There's the cashless trend, right? So you find all these trends, and then you have to figure out, well, who's going to benefit from it, right? Who can profit from it, right? So Brian Feroldi, our colleague, somebody I spent a lot of time talking with, talks about figuring out what stakeholders are going to benefit the most. And let's be honest, a lot of those trends, society wins, but maybe investors don't really ever make a lot of money. So figuring those two things out first is like the starting point for me. What's the trend driving a company's prospects, and how much is the addressable opportunity for that company to profit? Now, then when I start digging into the individual companies, there are a couple of key things that I like to see, right? So one thing is, who's running the business? What is their track record of success? And I kind of I take two different approaches here, right? One thing I love founder-led businesses, but I don't exclusively invest in founder-led businesses. But if I found a business that the founder is still in charge, still relatively young, has a lot of skin in the game, and has a long track record of success doing whatever they're doing, that's like a big green light for me. On the other hand, some of my biggest holdings, the founder has nothing to do with the business at all. But if there's an institutional history of success, that can carry a lot of value too, right? Winners continue to win, usually is the case. So those are kind of the key things that I look at if you were to kind of boil it down into 4 or 5 things.
Awesome. Yeah, I think that's great. I think that the trend stuff, I think, is something that I definitely use when it comes to, all right, where do I think the world is going to be in 10 years? What kind of insights do I have about changes that are going to take place? So for me, I've tried to really simplify things a lot, particularly through 2020. I think the big lesson for everybody is just that the future is very hard to predict. Even if you think you got a beat on what's going to happen tomorrow, you probably don't. And we've been reminded of that repeatedly this year. So one of them is just, can I understand it? Do I understand what's driving this business? Sometimes it can just be, common sense. So I've talked about online dating, just kind of observing how people behave around me. I remember when I invested in PayPal, the big kind of insight for me was they started accepting Venmo for paying for clubs on my college campus. And I was like, well, listen, this thing's going to be a runaway winner if everybody on here is using this platform. Something that's just simple and easy to understand, and kind of behaviors that are predictable or something that I look for. I kind of along those lines. I think as a beginning investor, you always get this idea of, I want to find this kind of unique thing that nobody else understands. Like I read this 1,000th footnote that nobody else saw. And one big thing that I've kind of reached is you don't get any bonus points for degree of difficulty or for uniqueness in the stock market. Sometimes those great companies are out there and they just hit you over the head and are pretty obvious. So I don't want to make things too hard on myself. I think David Gardner's on his podcast recently. One of his things that he talks about is, if it's a great stock idea, you don't have to think about it too much. Sometimes things you just understand them and they make sense. So I look for something like that. Along those lines, how easy is it to replicate? If you understand something well, you can see how hard is it for somebody else to enter into this market? What are the behaviors that are driving this business? And I think along those lines too is, I'll know when I'm wrong, right? If my insight turns out to not play itself out in the market, then that's something important. Then lastly is just, can it withstand uncertainty, and what's my risk and reward? So again, going back to what we saw this year, you want to understand, okay, in a worst case scenario, how much, like what's the worst possible thing that could happen to me, and then what's my upside available? Because no matter how good of a bead you think you have on what's going to happen tomorrow or next week or next year, you will be surprised. So try to have something where it's easy to understand, so you can stick to your thesis if it's still intact, and to where your downside is protected for when the inevitable kind of hits you. Those are kind of a few things that I look for. Obviously, not every investment checks every box, and I break my own rules all the time. Just like Ben Graham, I think would say his best investment he ever had, he broke his own rules. So not to say you won't look at anything in my portfolio and see me breaking that rule, but in a perfect world, stuff that can check all those boxes, be easy to understand, have a high risk reward, and be something that I think can withstand a lot of volatility, unpredictability in the market. That's something I really like, and have looked for as I talk about some of these companies we'll talk about today. So along those lines, Jason, the name of the show is our top stocks and energy industrials for 2020. What's a pick that you have for us for this year?
Yeah, this is a company that people hear me talk about an awful lot, and that should be a key that it's probably a pretty good business, and that's Brookfield Infrastructure. Trades under two tickers. There's BIP, which is Brookfield Infrastructure Partners. That's the limited partnership. And then there's BIPC, which was recently created, and it's a one-to-one economic equivalent, and it's a corporation. And there's a huge price. I don't want to focus too much on this, but there's a huge price variance. I think at market close yesterday, the BIPC traded to like a 35% premium to BIP. And the entire difference is that BIP is a limited partnership. BIPC trades as a corporation, so it's like Coca-Cola. And the reason that matters is because this is really a dividend investment and a dividend growth investment. And the bottom line is a lot of institutional investors will not invest in partnerships. They're very rarely included in indices, or they're more likely to be excluded from indices, maybe is a better way to put it, because there's different tax implications. The limited partnerships issue a Schedule K1. The dividends are typically taxed. The dividends that the distributions they pay to you, part of it might be taxed at your nominal your tax rate, right? So it might be taxed if you pay a 22-23% tax rate, maybe that's what you pay on it versus that 15% long-term capital gains rate on regular dividends. And BIPC pays regular dividends, right? So that's one of the things right there. It also issues just a 1099 div. So there's a lot of large money investors that will buy BIPC that BIP is excluded. So that's the biggest reason you see that variance there. So why am I interested in this company? Why is it a top pick for this year? So first of all, it's talking about the trends, right? So, we've heard for years and years and years that, U.S. infrastructure is in serious need of modernization and expansion, right? Whether you're talking about water infrastructure. Here's a stat that just blew my mind. This is something that American Water talks about. 20% of the treated drinkable water in the United States is lost in the system every year. 20% leaves the treatment plant ready to be consumed and never reaches a consumer, right? It's just lost. That the system is so aging and so old. You think about the electrical infrastructure, the fact that Edison would recognize most of the components as being things that he helped design. You think about our roads, our bridges. The list goes on and on, right? Besides the rail, which is owned by the railways, pretty much anything that's a public property is in dire need of modernization. And then you start just thinking about the growth, right? You think about around the world, that big trend of the global middle class. I think the exact number that the Global Infrastructure Hub, which is a G8 or G20 initiative, I can't remember which, says that between 2010 and almost 2050, like 2047, I think is the number that they peg to, the global infrastructure spend really needs to be like $90-something trillion, right? Just to modernize and to meet the global need. Over the next 20 years, the annual spend needs to be somewhere between $3 and $4 trillion every single year. That is a ton of money. And Brookfield is in the middle of this, right? I can't think of any other international company that's better positioned to play a role in the deployment and the modernization of all kinds of infrastructure around the world, whether it's water, whether it's transportation, ports, roads, telecommunications, natural gas, and other energy transmission, power transmission. This is their business. This is what they do, and they're very, very good at it in terms of generating returns. Since the stock went public in early 2008, it's up more than 584% when you factor in the dividend. It's absolutely crushed the S&P 500 over that period. The dividend has grown over 700% since it was initiated. And you can buy it today and capture, I haven't looked at it this exact moment, but it's around 4% dividend yield, which is very high, particularly when you consider the interest rate environment. That's because the stock is still down about 7% from the 52-week high back in November. It closed 2020 down about 1% over the full year. You think about a high-quality dividend stock with an incredible record of growing the dividend that's tied into some mega trends, and the stock fell last year. It's stunning to me. It's absolutely stunning to me that the Brookfield Infrastructure Partners stock is still as cheap as it is right now. And I think, honestly, it's my top buy right now for anybody that's looking for a long-term dividend growth stock. I love it. I absolutely love it.
So, Jason, one thing that I think is interesting with this company as well, you mentioned how big this opportunity is, but also just there's not a huge number of companies in the world that can go buy up and operate these infrastructure projects on such a huge scale, right? I mean, Brookfield, I don't know if it's in the Brookfield infrastructure entity, but I mean, Brookfield's like nationalizing South American power grids and things like that. Like, there aren't a ton of companies out in the world with that type of expertise. So you have this big opportunity and a limited set of people in a position to exploit it, at least in a big way.
Yeah, and there definitely aren't very many pure plays, right? So the Brookfield is a subsidiary. This is a subsidiary of Brookfield Asset Management, ticker BAM, which is one of the largest alternative asset managers in the world, right? And this is one of the instruments they use to acquire, improve, operate, and deploy those infrastructure kind of assets, which fall right in that alternative asset class for people that are looking for things besides stocks, right, or bonds. So it's right in their wheelhouse. And in terms of their history of allocating capital across the cycles, I mean, the corporate culture there is just incredibly good. They've had a couple of CEOs in Brookfield Infrastructure's history, but the corporate culture from the board through every part of the executive suite, and then all the way going back to the Brookfield Asset Management, the parent company, is incredibly strong, right? They have a process. They're really good at it. They're really good at being countercyclical. In other words, they like to play the game of having access to capital when nobody else does and everybody needs it. And that means they can buy great assets. They can go spend $1 billion or a couple $1 billion to buy an asset that's a regulated monopoly in an area, so they don't have to compete, right? I mean, think about the durable competitive advantages that their assets have. It's enormous. It is absolutely enormous.
Yeah, so I really like that one. So I tell you, for my first pick, I mentioned earlier you don't get any bonus points for degree of difficulty or for originality. So I'm not going to get any bonus points for Berkshire Hathaway. That's ticker BRK.B. Unless you're super rich and you want to buy the A shares, BRK.A. I don't have $300,000+ sitting around to buy one share of stock. But if you do, thank you for listening and give me a call. But yeah, with Berkshire Hathaway, I think you mentioned the movement on Brookfield Infrastructure. You look at Berkshire over the past year, basically hasn't really moved significantly, about 0.5% off its high over the last 3 years. But you look at how the company performed through the pandemic. This is a company that just can't be killed, right? You would think an industrial conglomerate would have some issues during the pandemic, have some type of speed bump. Operating cash flow up in the second and third quarters. So the company is now trading at 1.3 times book value. Berkshire, Warren Buffett has really turned on the buyback cannon in the most recent quarters. So they've bought $16 billion in stock so far this year during the pandemic, $9.3 billion of that in the most recent quarter. We've got data on September, paid about $216 per B share. Today, the shares are around $232, so maybe about 10 or 15% above where Buffett was really turning on the buybacks. But you say Berkshire really boring. But when it comes to the recovery, so you've got this valuation, right? Lots of the market is up super high. I would say Berkshire, from a value perspective, is about in the midpoint of where it's traded as far as price to book value over the past 10 years or so, 1.3 times price to book. So really reasonable valuation. And you look at how some of its underlying businesses set up for this recovery. So you've got the railroad. So if you want to transport anything in this country from LA, Chicago, or any of those western part of the country, Berkshire Hathaway's railroad, significant player there. You look at building supplies. Everybody's excited about trends. You want to invest in an exciting trend. I think one of the obvious ones right now is there's not enough starter homes for the demand that there is in the market. We've seen this huge spike up in home prices this year. We're going to have to see new homes built. Where they own Acme Brick, Benjamin Moore Paint, Shaw Carpet, Johns Manville Insulation. Did you know Berkshire Hathaway owns the largest seller of recreational vehicles in the world? We've had this huge year for RVs in 2020. You look anywhere within this company, and
Nick, I did not. I didn't know that.
yeah. So one of the ones I'm really excited about moving forward. Everybody's excited about electric vehicles. They own Pilot Flying J, and 38% now. In 2023, they're going to take their stake up to 80%. I think truck stops, when you talk about electric vehicles coming to market and taking a bigger share, they're going to do pretty well. You talk how long it takes to recharge these vehicles. You have to sit there at an hour to recharge your vehicle. Pilot Flying J is the third largest franchisor of quick service restaurants in the country. So when you talk about if I want to go to a place where I'm stuck for an hour recharging my electric vehicle, I think they own the property that may be the best positioned to do that going forward. So I think they have exposure to some of these trends, but really, the takeaway is you have this company generating massive amounts of cash. We just had basically the worst pandemic that could have happened to them, and they've powered through without any significant hiccups. Buffett is turning on the buybacks, as I said, $9.3 billion in the most recent quarter. They still have something on the order of $140 billion worth of cash on the balance sheet that he has available to deploy. And I think he's just going to keep buying back stock in an incredible way. If you look back, sometimes I'll go back and you can read some of his old partnership letters. There was one he wrote in October 1967 about kind of market conditions right before he wound down his partnership. He says, opportunities for investment that are open to the analyst who stresses quantitative factors have virtually disappeared after rather steadily drying up over the past 20 years. That sounds kind of familiar for where we've been over the past 20 years or so. He also talked about the size of the fund getting in the way of some of his opportunities. I mean, Buffett has had his incredible investment success with the Apple investment. That's about half of his investment portfolio today. But when you talk about the size of the company, if he's going to go pursue value opportunities, he's really too big to be going after a lot of this small value where would traditionally be his kind of bucket he would shop in. So I think what's going to happen is, like he did in the late 60s in the go-go market, you're going to see him start returning capital to shareholders in a really significant way. And I think we're going to see just massive amounts of buybacks from Berkshire Hathaway. They've already, Warren Buffett was already featured in the Will Thorndike's The Outsiders book, which is all about capital allocation historically and companies that really bought back massive amounts of their stock when opportunities presented themselves or where there just weren't great opportunities for redeployment of their capital. I think we're going to see a similar thing play out this time with Berkshire, and I think you're just going to buy massive amounts of stock, just plow their cash flow into that, and the stock is going to outperform the market as some of these other areas in the market are a little inflated relative to what they can produce. I just think Berkshire isn't appreciated for just the massive amounts of cash they can generate and how they can withstand basically, the biggest disruption
Any
you could
shock.
imagine for them,
Yeah.
and just power right through.
I've got a couple of observations about Berkshire. When we did our year-end pre-record with Lou and with Matt a few weeks back, we were talking about Berkshire, and I pointed out that for a 10-year period, at one point earlier this year, the S&P 500 had actually doubled, Berkshire Hathaway's returns, like in total returns over that same period. Like, it was just absolutely being crushed. And it's narrowed, but over the past 10 years, the S&P 500 has generated about 320% in total returns, with Berkshire a little bit around 250. So it's still, outperformed. But I don't think I've ever been more interested in buying Berkshire than I am right now. Talking about that book value, I pulled a chart just to look, and I think I mentioned too that it was like it had been 7 years since Berkshire had routinely traded this cheap. And you look back, and there's been little blips on the radar where Berkshire stock for a few days or a week fell to below like around 1.2 times book, but it always quickly regained that value, right? 2020, if you look at the sustained valuation that the stock has had for the entire year, this is the cheapest Berkshire has been for this long in a decade. I mean, really, you got to go back to the prior crash for Berkshire to be this cheap. And here's the thing. I think it's easy to anchor on that underperformance and not acknowledge that there was this change in the environment for banks and the way investors viewed banks that weighed heavily on the performance of the Berkshire stock portfolio. Buffett made a couple of really bad investments in big oil. The ConocoPhillips investment did not go well at all. The ExxonMobil investments did not go well at all. The IBM investment did not go well at all, right? So there were a handful of big bets that just didn't work. But you think about the strength of this operating business, and oh, by the way, we just had a 10-year market bull run that was almost unprecedented. And Buffett told us back before, he said, in strong bull markets, it's going to be hard for Berkshire to outperform. But when the market is down, that's where we can really win. So I think put all that together, and it seems like a lot of things are lining up in favor for Berkshire to be a great investment over the next decade.
Yeah, and I would just say kind of, oh, I'm taking up for Warren Buffett like he needs defending, but I mean, we shouldn't overlook the Apple investment. I mean, that's one of, I mean, he's got $100 billion in the thing. I mean, and Apple was the best performing FANG stock in 2020, even amidst all this stuff. So, I don't think the guy has lost it, despite a lot of the talk about his issues. I just think again, we see how big that Apple investment got, and the size of their investment portfolio, and just the limited opportunities you see in the market, just with how high private market valuations are getting right now. I think he's going to see the best opportunity being buy back your own stock, and he's just going to plow massive amounts of cash into it over the next few years, and if and when the valuation, catches up to where he thinks is fair value, we'll see. The last thing to point out is we're just a couple years on. So July 2018, Berkshire's board changed the policy around when they could buy back shares. So historically, it had been 1.2 times book, 20% above a book value. Once they were below that range is when he and Charlie Munger could purchase. They've since removed that restriction. So, wherever the stock goes, he could feasibly continue buying indefinitely if he sees that as the best use for capital. So we'll see. It cannot sit in cash forever, I'll tell you that.
Well, was it Dominion Energy, the pipelines that they purchased, and the LNG export facility there? I think we're going to see more of those sorts of things, like these steady cash flow assets that become wholly owned subsidiaries. I think we'll see more of that. And, Apple was like, that's Coca-Cola part two, right? That's this massive, valuable consumer brand that its IP isn't just the product that it makes, right? It's the name and the value and the ability to make this huge profits off of something that users really, really like. So, yeah, we'll see what happens next. But I love this pick, Nick. I really do.
All right, so we've got a couple more picks to run through. Let's do these next one kind of quickly. Jason, what have you got for your second pick?
Yeah, so this is a stock that's had a pretty good year. It's NV5 Global. The ticker is NVEE. NV5 Global is this is a microcap stock here. I think the market cap's maybe $1 billion, maybe a little more. But it's had a pretty good run lately, and the reason why is this is an infrastructure engineering company, right? So here we are with Democrats having control of both houses of Congress, and the White House coming up, and there's this idea that we're finally going to see a big push on infrastructure spending. This should be bipartisan. It should be something that gets done, right? I don't know if I buy into that happening or not, but here's the key, right? It's been great for NV5 investors over the past few months. And the bottom line is that whether it happens or not, this is a business that's going to continue to ride some of those same trends that Brookfield Infrastructure, my first pick, was set up to profit from. So here's the things that I like about Brookfield Infrastructure, right? Or excuse me, about NV5 Global. So this is a company that is founder-led. Dick Wright, the CEO is a founder. He owns over 20% of the company shares. And he has a really long track record of success prior to founding NV5, which has been around for over a decade. So the thing is, this is an acquisitive model. So right, so they grow organically, 8 to 10% a year, which is really solid. But they do make a lot of acquisitions, right? So there are a lot of bolt-on acquisitions of small engineering firms that maybe have regional. They have a regional coverage, or maybe they have a certain discipline that fits within the NV5 model. So they bolt on these acquisitions. They convert these acquisitions over to their back end, so they kind of wring out some of the costs. But then they also benefit from cross-selling, right? So if you hire, if you buy an engineering firm that focuses on one thing, and they're working with a client on a project, and they need engineers that do something different, or maybe they have a property in a different area that they need to develop or something like that, NV5 can meet that need that small engineering firm couldn't meet on their own, right? So that's how they can cross-sell, and that's where a lot of their organic sales growth come from. They're actually attached to the fact that the original deal maybe came through an acquisition, right? So the bottom line is it's hard to do this well, but NV5 has a really good model, right? They're really good at wringing out those costs. They're really rigorous about it. A lot of companies that do acquisitions end up really bloated. These guys have been really good about not letting that bloat come along for the ride. And you think about sales growth. This is a business. This is a company that still doesn't do $1 billion a year in revenue, but over the past year they've grown. I think they grew revenue something like 70%. Right? Just absolutely delivering. It's also a profitable business. And even with the stock price having run, say 60% or so over the past year, the forward price to earnings ratio is about 23 times, right? So this is a stock that still trades for a really solid discount to the market, which I think the forward PE for the S&P is over 30 times right now. It's just the market trades for really high valuations. So you can buy a very small company participating in a really big growth opportunity that's founder-led, that's profitable at a great price, right? I think it just kind of checks almost every single box for me. Again, the big caveat is the way that they've done a lot of their growth is a hard way to do it. And the bigger they get, the harder it's going to be to find acquisitions to give meaningful growth. But they're still so small. I think it's a great company to buy.
Awesome. Yeah. So NV5. It's an engineering firm. So they're folks who are doing the construction of some of these projects.
Yeah. So they do the engineering. They do a lot of the pre-work. They do project management. They recently made a big geospatial services acquisition, so that's a big deal in the West with the wildfires and all that stuff, to do geospatial work and to help companies like power line transmission and that kind of thing. So they've kind of expanded a little bit outside of their initial scope, but it's a really smart place that they've expanded into. They've been really, really disciplined. So yeah.
Awesome. So my second pick, just quickly, is Texas Pacific Land Trust. I discussed this company on December 10th with Luis Sanchez. Stock's up about 15% since then, trading at about a little over $800 a share. Today, it's Texas Pacific Land Trust. On January 11th, it will become Texas Pacific Land Corporation. So if you listen to the episode back on December 10th, the history of this company goes back to the 1800s. There was a company called the Texas Pacific Railroad that went bust and had a certain amount of land. They formed a trust for the shareholders in that company to hold and maintain that land over a period of time. Well, we're here 120, almost 140 years later. And that company is now is going through the process of becoming a corporation. So on January 11th, they will distribute 1-for-1 for shares of Texas Pacific Land Trust. They will distribute shares to Texas Pacific Land Corporation. The phone number is the same. The address is the same. The ticker is still the same, TPL, but the company will change into a corporate form. So just from a business operations point of view, what's interesting about this company? Well, I think over the past year, obviously really rough for oil and gas. The oil price is down significantly as demand throughout the world has fallen. Also, there was some supply issues, obviously, in the spring with Saudi Arabia and Russia kind of going to war with one another. But now we've seen prices stabilize. They're above $50 now. Saudi Arabia has done a significant cut in an attempt to support the market, and it appears with demand returning later this year and with the measures that some of these producers are taking, we're in an environment that should be constructive for oil prices. So we said, okay, oil prices are headed up. Generally, a lot of these companies that would be exposed to that aren't attractive investments. So we've talked about on the podcast a lot about exploration and production companies. You have these fixed costs you got to put in to keep your wells maintained and that sort of thing, which are exposed to lots of commodity risk. These companies sometimes have misaligned management teams, those types of issues. So you don't necessarily want to invest in those businesses. But what Texas Pacific Land Trust gives you is a way to get some exposure to that without having some of these operations that an E&P company has. So just kind of straight from their perspectives, TPL Corporation is one of the largest landowners in the state of Texas with approximately 880,000 acres of land comprised of a number of separate tracts located in 19 counties in West Texas. They also own royalty interest on 128th royalty interest on 85,000 acres of land and a 1/16th non-participating royalty interest under 371,000 acres of land in western Texas. And 4,000 additional net royalty acres. So they own, basically they own massive amounts of land in West Texas that includes, so this is the Permian Basin. This is the area where among these shale plays where the cost of production is the lowest, where you hear a lot of these companies that have talked about focusing their investments like Exxon and Chevron and others said, hey, we're going to de-emphasize some places like the Bakken. We're going to emphasize the Permian where our prices are lowest. So to the extent oil production is reducing, and it certainly is reducing in the U.S., some of those dollars are going to flow to the Permian, which is where Texas Pacific Land Trust is located. So they have surface rights. That's where you see pipelines and the like constructed. Just on January 4th, Kinder Morgan turned on their Permian Highway pipeline, taking natural gas out of the area. It's fully subscribed on regular contracts. The big issue in the Permian for the longest time has been takeaway capacity. And if you want to install these pipelines, Texas Pacific has those surface easements that folks have to pay them to get access to that as well. As I mentioned, they have this royalty acreage. So whenever oil gets pulled out of the ground on the acreage that they control, they get income coming in. So they don't have to pay to build the pipeline. They don't have to pay to drill the wells. They just get an income based on the oil and gas that's produced. And they're predominantly in the region, in the Permian Basin, where we're going to still see some continued production of oil and gas. So essentially, you look at the balance sheet for the company, no debt, over $300 million in cash. If you look at their free cash flow yield, so this is just their free cash flow divided by the market cap of the company. Kind of it's the inverse of the free cash flow multiple, if you like, the price to free cash flow multiple, if you like to look at that. It's basically the highest it's been in 5 years. We have this conversion taking place. Jason mentioned earlier with the Brookfield Infrastructure Corporation, how their conversion opened up access to a broader variety of investors. Those same factors are at play here with the conversion to Texas Pacific Land Corporation. The other thing is you just get better corporate governance. This has been in a trust management style for in excess of 100 years. The trustees were appointed for a lifetime appointment. Now you're going to get regular reporting. They're going to have a new board in place, 8 of 9 members being independent. Different incentives, right? If you're a trustee, you're just trying to preserve these properties going forward. You have a lifetime appointment. Nobody's going to fire you. If you were a manager, someone who is a corporate manager, you can get fired if you don't do a good job, and you have incentives based on the performance of the company and all those sorts of things. So what you're getting with Texas Pacific Land Trust is exposure to what is likely to be an area of the U.S. where oil and gas production continues, where there's demand to either get pipelines installed on their land or to continue to extract oil and gas from that region. You get it in a company with a super strong balance sheet, so even if there's continued volatility in the oil and gas market, this company is not going to go bankrupt on you. They're going to stick around to collect that value, and that value really is the oil and gas in the ground. And I think today, if you look at the valuation relative to where it's been in the past 5 years, it's attractively valued. Issues that might not work out for them, obviously, if oil and gas prices are low over a period of time, people might not choose to produce oil and gas on their land, and they don't get money if no oil and gas comes out of the ground, or if nobody's using those surface easements to install new pipelines because producers have decided to not install more pipelines. But if you do believe that oil and gas production is going to continue in a meaningful way in the Permian Basin in the U.S., and I think it will, because if you want to think about it just from the future perspective, we need natural gas to light our homes. I know renewable energy is certainly on the rise, but natural gas is going to be an important contributor to our energy grid for decades to come, just as oil is going to be a important contributor to travel and those sorts of things. Also, from just a national security point of view, Permian Basin is probably our greatest asset when it comes to oil and gas production here in the country to develop over the next few decades. So does that mean we're ever going to get our production back to the peak it was a few years ago? No, but I do think they're going to continue generating cash out of this region for a long period of time, and Texas Pacific gives you some exposure to that.
Crazy stat. Last week, I don't know if you saw this, you probably did, 0 barrels of oil came into the United States from Saudi Arabia.
When's the last time that happened?
I can't remember. I can't remember, right? And that's happened in a large part because of the Permian Basin, the Bakken, the development of a lot of these shale resources. So it's valid. The thing I like about this the most, Nick, is there's exposure to prices, right? Because low oil prices mean lower royalties they have, because it can affect volumes that come out of these areas. But this is, if you believe, as I do, that oil and gas are going to continue to play a role, this is a great way to invest in the production without taking on the risk that every independent has, which is you can't get what it costs you just to get it out of the ground, right? This is the best. Own the royalties, own the real estate. Let somebody else deal with producing it.
Absolutely. I think we've talked about AirCap on the podcast in the past as a way to invest in an airline recovery. You own the airplanes.
Yep.
Even if the airlines go bankrupt, AirCap has these planes that will continue flying. There's still demand to fly, still demand for that value that airplanes represent. And I think in a similar way, Texas Pacific is in a similar spot, right? So whether these E&Ps go bankrupt or not, that oil and gas in the ground has value, right? It has value for what it can be done, what we can do with it, and fuels or fertilizer or chemicals or plastics or all those sorts of things. That has value and will continue having value whether these producers go bankrupt or not. And Texas Pacific owns the option on that value. So that's the scenario you're in with these companies. All right, Jason. So those are our stocks we ran through. So we've got Texas Pacific Land Trust, soon to be Texas Pacific Corporation, TPL, Berkshire Hathaway, ticker BRK.B. If you're a regular person, and if you're super rich, you can do BRKA. And then, Jason, what were your two picks for us?
So the second one was NV5 Global, ticker NVEE, and Brookfield Infrastructure, the Infrastructure Partners, ticker BIP, and then Brookfield Infrastructure Corporation's BIPC. I encourage people that it makes sense to buy BIP at the current valuation.
All right, yeah, and if you want to see more information on Texas Pacific, like I said, you can go back to our December 10th episode. I believe we've talked about the Brookfield companies over and over again. So look back anywhere in our history, and you'll be able to track it down whenever we're talking about renewable yield cos or any of that sort of thing. Jason, always love having you on the podcast to talk about some of our favorite stocks, and I'll look forward to having you on again next time.
Thanks. This was fun. Sure, we'll be talking soon.
As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed, so don't buy or sell anything based solely on what you hear. Thanks to Tim Sparks for mixing the show. For Jason Hall, I'm Nick Sciple. Thanks for listening, and Fool on.